Hi class, a pleasant day to all of you. This is your Professor Dan, and in this video, we are going to discuss the continuation on the formation of partnership. In the previous video, we discussed the formation of partnership of individuals. And in this video, we are going to discuss these lessons. Okay, first, we are going to identify the accounting considerations on the formation of partnership involving sole proprietor. In the previous video, we have discussed the formation of partnership of individuals. Here, we are going to focus our discussion on the formation of partnership involving sole proprietor. So here we are going to illustrate the accounting considerations on the formation of partnership of sole proprietor with an individual. And we are also going to prepare the opening statement of financial position of the new partnership book. Okay, class? Class, in the previous discussions, we have learned that a sole proprietor can enter into a partnership with an individual. Okay? The partnership can be more than one individual, or it can be more than one sole proprietor. Okay? And this, they can enter into a partnership. In our discussion, we are going to illustrate only one sole proprietor and one individual entering into a partnership because the concept will be the same. Even one or two proprietors, one or two individuals, or more than two, then the concept are still the concept is still the same. Okay, let us start. So let us take a look of the accounting procedures on the partnership with sole proprietor. There are certain preparations that have to be made. There are certain accounting considerations before a sole proprietor can enter into a partnership. If this is the business of the sole proprietor, then these are the things that are to be done by the sole proprietor. First, cease the business operations of the sole proprietor and prepare the financial statements, which are the income statement and the statement of financial position. So with this, you have to the sole proprietor should close the income statement and record profit or loss to owner's capital of the proprietor. Then after that, the sole proprietor should prepare the post-closing trial balance before formation of the partnership. Then after that, the sole proprietor should record the revaluation of the assets to reflect the values agreed by partners or the fair market value. Because the other partner will take a look of the amounts of the assets reflected in the post-closing trial balance of the sole proprietor, and they have to make an agreement as to the valuation of the assets. After it is revalued, okay, whatever increases or decreases on the revaluations of assets will be adjusted on the owner's capital account of the proprietor. So, whatever increases will be added to the capital of the proprietor. Whatever decreases will be deducted from the capital account of the proprietor. We will see an illustration on that. Then next, the sole proprietor will prepare the adjusted post-closing trial balance after revaluation of assets. Then with that, with the adjusted post-closing trial balance, then we can now record the investment of the sole proprietor in the partnership book. Okay? So here in the partnership book, we will record the invested assets of the sole proprietor in the partnership book. The adjusted post-closing trial balance will serve as the basis in recording the sole proprietor's investment in the partnership book. And then after that, after recording the sole proprietor's investment, we can now record the other capital contributions of other partners. Then after that, we can now prepare the opening statement of financial position of the new partnership. Okay? So remember this. These are the accounting procedures on the partnership with sole proprietor. Okay, let us have an illustration. This is our situation. Espanol plans to enter into a partnership with trusted associate Kino on February 1st, 2021. Profits or losses will be shared equally. Espanol is to transfer all assets and liabilities of her shop to the partnership after revaluation. Below is the post-closing trial balance of Espanol business after closing entries on January 31st, 2021. So this is the post-closing trial balance. The name of the business of Espanol is Fish. So Espanol has already prepared a post-closing trial balance on January 31st because the formation of the partnership will start on February 1st, 2021. Okay, so this is the post-closing trial balance of Espanol's business. Okay, and the other information is this. The agreed valuation is as follows. So based on the post-closing trial balance, there are agreements made by Kino and Espanol on the valuation of these assets. And these are accounts receivable net is 140,000, inventory is 460,000, and equipment net is 124,000. And with this revaluation, Kino will invest cash equal to Espanol's investment after revaluation. Okay? So the partnership will operate under the business name of Fish RS. So it's no longer Fish. The partnership name will be Fish RS. Okay, so required. Prepare the opening journal entries in the books of partnership. Next, prepare the partnership statement of financial position as of the date of the formation of partnership, which is in this case February 1st, 2021. So we have to prepare the statement of financial position, okay, as of February 1st, 2021. So again, class, required journal entries in the books of partnership and the statement of financial position as of the date of formation of the partnership. Okay, let us move on. So let us conceptualize, okay, and visualize the the situation. So we have here Espanol, and Espanol has a business, and Espanol has already prepared the post-closing trial balance of her business. And then there was an agreement on the valuation of the amounts of the assets of Espanol, and these are the agreed valuation of Espanol with the incoming partner Kino. Okay, they both agree on this. Okay, and Kino will be admitted as partner, and the investment of Kino will be cash equal to Espanol investment after revaluation. Okay, so that is the agreement. Let us move on. So in Espanol book, this is what we have. Okay, And this is the agreed valuation. Okay, let us take a look. On the agreed valuation, accounts receivable 140,000, inventory 460,000, equipment net 124,000. So let us do first accounts receivable. In the books of fish, this is what we have. Accounts receivable 150, allowance for uncollectible accounts 16,000. So the accounts receivable net based on the books of fish is 134,000. And the agreed valuation is that the accounts receivable net is 140,000. So here we have to reflect this 140,000 as the accounts receivable net. So what is the difference between the books and the agreed valuation? It's a 6,000. How can we reflect 140,000? How can we do the adjustment? Okay, of course, the accounts receivable gross will remain 150,000. Since that allowance for doubtful account is only an estimate, then we will have to use this, okay, to adjust the accounts receivable net 240,000. So what we can do is reduce the allowance by 6,000. Reducing that by 6,000, it means that we should only have an allowance at 10,000. So to do the journal entry for that, we have to debit allowance for doubtful accounts of 6,000, and then this 6,000, since that we are increasing accounts receivable, so we are going to increase the capital also at 6,000. Okay? So if we are going to look at the post-closing trial balance initially prepared by Espanyol, after doing these adjustments, we will have to deduct 6,000 from the allowance, so, and we have to add 6,000 on the capital. So in this case, this will be the new balances of these accounts, since that it is minus and addition on this on the credit side, so the total will still be the same. Okay, let us move on. Okay, so this is now what we have, and this is the agreed valuation. We are done with accounts receivable. Our valuation now will be on inventory. Okay, this is what we have. Per books, our inventory is 440,000. Okay, and based on the valuation, our inventory should be 460,000. Class, you will note that the valuation is the assets had increases, because this is, I think, what Espanyol's position. I think in this situation is Espanyol is on a better position to negotiate. Okay, and possibly Kino accepted the valuation because probably that is an accurate, a sound evaluation, okay, or revaluation of assets. So of course, Kino will not just say yes if it did not see the status of the inventory or the condition of the inventory. So in this case, the valuation of inventory is 460,000. So there is an increase by 20,000. So we have to record the increase. To increase inventory, we have to debit inventory, and the increase now will be credited to Espanyol capital. So in this case, the inventory will be added by 20,000, so, and the capital will be increased also by 20,000. So now our inventory is 460,000 and our capital will be 666,000. Okay? And we will have a new total. Next is, so this is after doing the accounts receivable inventory. This is now the adjusted amounts. So the agreed valuation, we are done with accounts receivable and inventory. So last account is the equipment. So here, our equipment per book data is that equipment is 135,000 and there is an accumulated depreciation of 75,000. Okay, so the net book value is 60,000. But here, the equipment net book value is 124,000. It has a very huge uh, um, valued amount, okay, more than two times. So the difference of this is 64,000. So to do the adjustment, of course, we cannot increase the cost of the equipment. So since that the accumulated depreciation is an estimate, we can reduce the accumulated depreciation by 64,000. So that will be 11,000. So our entry would be debit accumulated depreciation equipment of 64 and credit Espanol capital of 64. All of these adjustments will be done on the books of fish, okay, on the sole proprietor's book. Doing this adjustments, we will have here reduction of 64,000 on the accumulated depreciation and then additional 64,000 on Espanol capital, okay? Okay, class, so based on the adjustments, we will have now this adjusted post-closing trial balance. Okay, now take a look, class. Before the adjustment, the capital is 640,000. And after the adjustment, the capital now is 730,000. Okay, all adjustments have to be reflected in the capital. Okay. So now, class, we have now here the post-closing trial balance as of January 31st, 2021 after the asset revaluation. So now, since that the fish business will be closed, okay, we have to do the proper closing of the books on January 31st in the fish uh, record or in the sole proprietor's business. Okay, to do that, we have to debit all the credit account and credit all the debit account. So it will be formally closed. So debit all the credit, which are allowance, accumulated depreciation, accounts payable, and Espanol capital, and credit all the debit, and that will close the business. No more fish business, okay? It's already closed. So where will the assets go? Where will the assets go if the business is closed? The assets will now be in the hands of Espanol on her personal account. So her Espanol will receive from Fish as her personal account the assets and liabilities. Okay? So now, if Espanol will record these assets on her personal account, so Espanol will now have cash of 36,000, receivable of 150,000, and inventory of 460,000, and an equipment of 135,000. And then will have the corresponding contra accounts, and however she will have an obligation of 30,000, and then her net worth will increase by 730,000. This will be recorded on her personal account because she will be receiving this. Okay. Okay, class. So we have learned that that Espanol now the fish business assets and liabilities is now with the personal account of Espanol. Okay, and uh, this is what will be the record on the personal account of Espanol. Okay, so she has these assets and she has these contra accounts and liability and an increase in her net worth. And now, Espanol will invest this in the partnership. So to invest it in the partnership, she has first to record this, okay, by crediting this because it will be crediting the assets because it will be invested in the partnership and debiting all of this. But instead of her net worth, it will be investment in partnership. Okay, so Espanol will record this investment in partnership 730,000 in all the contra accounts. Okay, and then all the asset accounts will now be transferred in the partnership book. So class, if you will look at the personal record of Espanol, okay, cash will be canceled, okay, because there is a debit and credit here. It was now transferred. Accounts receivable will be canceled, so it means that it's no longer in the personal account of Espanol. Inventory will be canceled, so it means it's no longer in the personal account of Espanol and the equipment, because all of these assets will be transferred in the partnership book, as well as the contra accounts and the liabilities. What will be left uh, if we are going to do this entry will be investment in partnership of 730,000 and the net worth of 730,000. It will remain now that the net worth of 730,000 is no longer these assets but the investment in partnership. That will be as far as the personal record of Espanol is concerned. Okay. Now, requirement number one in this problem is that we will prepare the journal entries in the partnership book, Fish RS. You see, class, we will not be able to prepare the journal entries in the partnership book if we did not make the necessary revaluations of assets. Okay? So it is first important that you have first to revalue the assets before you can prepare the journal entries in the partnership book. So in this case, the partnership will receive the assets here because it will be transferred. It was already removed from the personal account of Espanol. So here we will be debiting all these assets, okay? So we will record the investment of Espanol on February 1st, debiting cash, accounts receivable, inventory, equipment with these amounts, and crediting allowance for doubtful accounts, accumulated depreciation, accounts payable. And now the partnership will give Espanol the capital account, the capital on the partnership, which is 730,000. And that is the investment in partnership on the record, on the personal record of Espanol. Okay? And for Kino, the agreement is Kino to invest cash equivalent to Espanol's investment. How much is the investment made by Espanol? 730,000. So Kino has to put her cash in the amount of 730,000. So here, she will give the partnership 730,000 as her investment. So on her personal record, there will be a reduction of cash. So that cash is now investment in partnership. So in the partnership book, the investment of Kino will be recorded as the partnership will receive a cash of 730,000 and then give Kino capital 730,000. Okay? Okay, class, that's it for our illustration. Now, on the journal entries, now if we are going to prepare the statement of financial position, if we are going to recall the entries made in the partnership book, this is what we have. On the investment of Espanol, this is what we have. And on the investment of Kina, this is what we have. So based on this, we can prepare the opening statement, which is requirement number 2. So this is Fish RS now. This is the new name for the partnership. And this is the statement of financial position. Also, the assets will be all of this. These are all the assets. Okay, so our cash is 730 plus 36. So we have cash of 766,000 and record all of these assets. Accounts receivable 150,000. You deduct the allowance for doubtful accounts of 10,000. You will have net of 140,000. You have inventory of 460,000. You have equipment of 135,000 less 11,000. So you have here 124,000 for your equipment. And your total assets, adding all of this, is 1,490,000. Okay, and for your liabilities and partners' equity, we don't have yet any receivable, any payable. Okay. Oh, I'm sorry. We have already accounts payable of 30,000. Okay. We are assuming the payable of Espanol. Okay. And we have here Espanol capital of 730,000 and Kino capital also at 730,000. So the total liabilities and equity is 1,490,000 as well. Okay, so our statement of financial position for Fish are as effective February 1st, 2021 has a total assets of 1,490,000. Okay, class, that's it. And if it is sole proprietor with sole proprietors, so basically it's the same. You have to revalue. They have to follow the accounting considerations and then revalue the uh, assets. Okay, class? So that's it for now. Have a great day and let me know if you have questions. Bye for now.